Well, good snowy morning. The purpose of this video is to go over some measures of risk, to describe kind of how we translate these measures of risk into reward to risk trade-offs, which are really central to sort of how we think about investments, and then show some examples in practice with actual data. Just to give you a broad overview, kind of what we're going to talk about. When I say measures of risk, primarily I mean the sample standard deviation, and that's kind of has a kind of a historical flavor to it. But like the goal in this is to show that actually the sample standard deviation isn't such a bad measure of the type of risk that we think about in an investments context. And then here, when we talk about reward to risk ratio or trade-off, we'll be thinking about what's called the Sharpe ratio, named after this guy named Sharpe. So we can we'll talk a little bit about this conceptually. I'll kind of show you where in the notes to find this, etc. So sort of following along this MS investments course. We're here in the Chapter 5 notes. If you have that downloaded, what you can see is that we'll be sort of in section 2.4 on historical standard deviation and the Sharpe ratio, and section 2.5 measures of downside risk. My goal is to talk about measures of risk first, and then talk about the Sharpe ratio. So I'm going to talk about standard deviation. It's sort of weird cousin value at risk, and then some of these other kind of measures, expected shortfall, etc. Just kind of fix ideas about sort of what actually is risky, and then we'll proceed to talking a little bit about the Sharpe ratio, and then I'll show you in R sort of what to do. If you're following along, we have this script working with returns, and then we need to download to a folder where we know where it's saved, this spyrets.csv. This gives us, this was downloaded from Yahoo Finance, gave us returns on the exchange traded fund SPY, which tracks the S&P 500. Part of the goal is to just show you what returns look like in practice, and in particular thinking about, well, do they look kind of like a normal distribution or do they not? Because that's actually going to be central to whether we think standard deviation is a good measure of the type of risks that we face. Okay, so let's kind of get back to kind of where we are in the notes. We've had in our quant class this notion of what the sample standard deviation is. We think of this as kind of like when we were thinking about the arithmetic mean as an estimate of the expected return for the next holding period. We're going to think about the sample variance formula here as an estimate for what we think of as the variance, the true variance in the next holding period. We think the next holding period return is a random variable. It has a variance. It has an expected return. We'd like to know about each of these, partly because under the assumption of a normal distribution, these returns tend to be sort of normally distributed. I'm going to sort of open up a new script just to give sort of a graph of this. I'm going to go from -3 to 3. That'll give me a grid. And I will then go sort of plot this. I can find kind of the density on this grid. And then if I want to sort of plot and see what sort of this sort of density looks like, I can say here's my type equals a line, and I just want to sort of plot and show you kind of, if returns look like a normal distribution, we'll kind of have this normal distribution, and returns kind of are around where the average is, but they can be kind of higher versus lower. Well, nice thing about normal distribution is that all you really need to know is kind of what the mean is and what the standard deviation is, and then that tells you kind of about every feature of the distribution. Now, sort of looking at this distribution, imagine that this is a return distribution. Would I care, or would I be worried about ending up kind of on this kind of upper spot? That is, would I be worried about, would I consider it risky if I ended up having sort of a large return? I think the answer is no. I think that would actually be a really good thing to have a large return. And I mean, people buy lottery tickets for this reason. They like the variance. They don't just like the variance that like they could lose money, but that's not where the variance comes from the lottery ticket. Variance comes from, for a lottery ticket, variance could be very good in that you can get really amazingly good outcomes in reality. However, this is a tale of two tales. With a normal distribution, you're just as likely to be kind of in this upper tail as you are to be in this lower tail. And that lower tail truly reflects what's risky. Like ultimately, what we think of as risk is the chance that we could get kind of that lower tail outcome, right? And so if I, for example, were concerned with like, well, what if, see, I'll just go ahead and overlay a line here on the plot. And see, this upper tail, I'm not so concerned about getting returns that are above that red line. In fact, that would be great. I would love for that to happen. However, I am concerned about receiving returns below this other red line. That's kind of what we think of as scaring an investor. That's sort of what we would think of as risk. So it'd be nice to be able to quantify, well, what's this sort of bottom percentile? And so how can I do that kind of in general? Well, in general, what you'd like to do is you'd like to take, well, what's the, how do you get, say, the fifth, I mean, ideally, I'd like to find, well, what's the fifth percentile of my return distribution? Fifth percentile of my return distribution is just, it would just give me an idea of like, well, how bad is a bad case scenario? It's not the worst case scenario. There are 5% of days or 5% of holding periods where you can expect to get worse than that fifth percentile. But that fifth percentile can provide you a measure of, well, how risky truly is this distribution of returns that I could receive. Right? So that fifth percentile has a special name in finance. It's what's called the value at risk. All you do is you take the fifth percentile of your return distribution, and it tells you kind of a bad case scenario for your investment. Now, the nice thing about the value at risk in the case of normal returns is that all you really need to know what the value at risk is you just need to know, well, tell me about the sort of lower tail of the distribution. And because a normal distribution is fully parameterized, fully specified by the mean and the standard deviation, it turns out that knowing the standard deviation tells you how much lower the value at risk is relative to your expected return. So in particular, if you wanted to know, well, you have a normal distribution. Suppose you know that it's got a mean of 0 and a standard deviation of 1. And so like that, those are the defaults within R. And you want to know, well, what's the fifth percentile of that normal distribution? That is minus 1.65 or 1.645. That's a very familiar quantile of the normal distribution. And what does this mean in practice? What it means in practice is that for normally distributed data, you can expect that the fifth percentile outcome is 1.645 standard deviations below the mean. That is, knowing that what the standard deviation is going to actually tell you what the sort of worst case scenario is. So let's actually do a couple of examples here. So suppose that I want to know, well, what's the value at risk? I know my mean of my return distribution is 5%, and the standard deviation is say 15% for a particular asset. What's the sort of fifth percentile as long as the returns are normal? Well, all you need to know is the mean is 5% and the standard deviation is 15%. And then this Q norm will compute what number is 1.645 standard deviations below the mean. Now, to kind of illustrate this, let's just kind of do that calculation by brute force. 0.05 minus 1.645 times the standard deviation, you get the same number as the Q norm gives you. This built-in function gives you the value at risk. And it's just a quantile of a normal distribution. So it gives you the value at risk, assuming that the returns are normal. If returns aren't exactly normal, what's going to happen? Well, if returns aren't exactly normal, this is going to have some error. It's not going to be quite exactly right. And so so when you say like I'm looking for what like the fifth percentile of some data, that can be kind of a way to go. So imagine actually instead of sort of just doing this Q norm and using the assumption of a normal distribution, suppose instead you say I have data that was simulated from a normal distribution. Say I had 100 holding periods. There was a mean of 0.05 and a standard deviation of 15%. So I've got return data. So you'd say, okay, here are my data, and you'll see that look, the data, if they look, I mean, this is what we know it was drawn from a normal distribution. It's only 100 observations. It maybe doesn't even look normal in practice because of just chance. Now, suppose that I were to say just use my return data to then try to compute, well, what then is the value at risk? What R has is a function called Quantile. And you can say, compute the Quantile. Tell me the fifth percentile, or the 0.05 quantile, and that will give me kind of an estimate for what the value at risk is. That is, it's going to line up the 100 returns that we generated from this distribution. It's going to pick the fifth percentile, the one below which 5% of the data lie. And you can see here that's about minus 13%. And that's actually pretty close to kind of that brute force thing that we had done before. We could do this run kind of this code again, and we see we get something that's minus 17%, or in practice minus 19%. You can see that these are actually getting pretty close to kind of what the calculation was in reality, assuming that we had a normal distribution and just using the mean and the standard deviation. Notice this quantile part didn't assume normal, but in the case of normally distributed returns, it actually gives us something that's in the ballpark, that's pretty close. When I say in the ballpark, this is sort of the right number to capture the value at risk. It tells us the sort of fifth percentile outcome in the return distribution. This one is one that sort of links that to, well, what is actually the standard deviation? Because the formula for this is just the mean minus 1.645 times the standard deviation. So something to sort of point out is that if all I did was, let's kind of take the normal example. I'm just going to look at 3 cases. I'm going to look at one case where we have a standard deviation of 5%. I'll look at one case where we have a standard deviation of 10% and one where the standard deviation is 15%. Notice increasing standard deviation, what's that going to imply for the value at risk? Well, the value at risk for the low standard deviation is only minus 3%. That's the bad case scenario. Here, value at risk for the medium case standard deviation is 11.4%, so it's worse. and the value at risk for the 15% is still worse. But what this goes to show is that if I wanted to think about value at risk getting lower, meaning more risk, or standard deviation increasing, really both of those kind of capture the same essential idea, is that that worst case outcome is kind of directly linked to what the standard deviation of the process is. And so under the case of a normal distribution, we don't actually have to make a distinction between what's the downside risk and what's the standard deviation of the return process. As returns kind of look less and less normal, that is, as they have kind of more skew or they have more kurtosis, that breaks this relationship. Now this is important because kind of in practice, what we're going to do is use the standard deviation as our measure of the riskiness of an investment. And that's going to have a lot more intuition when we start thinking about things like diversification. Then something where we think about like how much value do I have at risk. Value at risk is going to have this sort of the same sort of math that happens, but we're not going to have kind of the same kind of intuition. The standard investment model is going to think of the standard deviation as our measure of risk for this reason. And if you're thinking about sort of a normal return process where sort of being in the upper tail versus being in the lower tail are kind of equally likely, and sort of how extreme those tails are is fully determined by like what the standard deviation is, it's not such a bad assumption to say that the value that the standard deviation actually measures this notion of riskiness of an investment. Right. The other nice thing is we could sort of illustrate sort of different cases. Say, think about the mean of the returns as the reward and the standard deviation as the amount of risk. So we could sort of imagine actually just picking out sort of different cases. So here you could say, well, here's, let me get, I'm using MS Paint, which is a very fancy product for doing exactly what we'd like to do here. So you can sort of imagine, well, here's kind of the reward. I'm going to make that thinner. So that's at sort of 5%, which is true of kind of all of these returns. And then you could imagine that risk could either be at, I'm going to do this in blue, 5%, at 10%, or at 15%. And yeah, we could go ahead and draw kind of a line connecting these points, just to kind of illustrate kind of where these points are on the graph. Think about these as just dotted lines to kind of indicate the position relative to the axis. And then, I mean, the question is, in investments, a heuristically sort of good approach would be to, it'd be nice to have sort of higher reward to risk ratio. Well, how can you illustrate the ratio of reward to risk on this graph? Turns out it's very simple. What you do is you just connect a line through the point of the amount of risk that you're considering, so 5%, and the amount of reward that you're considering. So for this, say a portfolio could give you 5% reward and with 5% standard deviation of returns, this line would kind of characterize, sort of the slope of this line would then characterize sort of what's that risk to reward ratio. You do the same thing for kind of these other points. And there's sort of illustrating a risk to reward ratio of sort of 1/2. 5% divided by 10%, the slope of that line is 1/2, and that kind of gives you this risk reward trade-off. And same thing here, 5% to 5%, there's a 1 for 1, and then this is 1 for 3. 1/3 would be the slope there. The slope of this line has a very special name in investments. When you take sort of the ratio of sort of excess return, which is the reward you can expect in your portfolio, to the standard deviation of your portfolio, that ratio is called the Sharpe ratio. So the slopes are equal to what's called the Sharpe ratio. Slopes of these kind of rays coming out from the origin are called the Sharpe ratio, which is the expected return, say minus what you get for risk-free. Suppose that that's going to be 0, and that's just divided by standard deviation of returns. That kind of ratio plays a really important role within finance, and you can see that like it's a ratio. As long as you think about the standard deviation of returns as a measure of risk, that it is actually a ratio of reward to risk. So hopefully, kind of in this first part of the video, I've shown you kind of that as long as we have returns that are kind of somewhat normal, this idea of using standard deviation of returns as a proxy for risk isn't such a bad idea. And then secondly, when we actually go to quantify sort of the reward to risk ratio in a portfolio, that reward to risk ratio in a portfolio is going to be pretty sensibly quantified as this return, expected returns, divided by the standard deviation of the returns. Or if there's something that's risk-free out there, maybe in the numerator we'll subtract out the sort of what we could have earned without taking risk. But essentially it's just going to be this ratio of the reward to the amount of risk. And hopefully this gives you a sense of that in the normal case, having risk or having standard deviation actually corresponds with that notion of downside risk. Okay, so let's actually use this to start illustrating this with return data, not just simulated data, not just sort of a theoretical normal distribution, but actually the data that are out there in the market. Sort of before this, I downloaded from Yahoo Finance some, I believe they're monthly returns from the S&P 500 index. What we do is we take the adjusted close and look at the percentage change in the adjusted close from month to month as it is reported in Yahoo Finance. That file is saved in my downloads folder. I'm going to show you kind of where it's saved here. So it's saved here in my downloads folder. You can see it here. It's called SPY RETS. If you're in the class, you can kind of download this. If you're kind of elsewhere, you can follow along by just going and downloading that file. Now, to read data into R, we just need to make sure we have our working directory pointed in the right place. Might have this pointed at the downloads folder. You can see this gets me the right working directory to start things. Now I can just refer to the file name and read in this data set called SPY, S-P-Y. 60 observations, so 60 monthly holding periods in historical data. There are 9 variables because there's a lot of junk that comes from Yahoo Finance. We can see what these 9 variables are. There's the date, open, high, low, close, adjusted close, volume, and then some columns that I added when I downloaded this into Excel and wanted to compute the returns. First, what we did is we computed from sort of month to month what the gross return is. That is just the ratio between the current price and what the price was last period. That sort of gives you sort of how returns accumulate over time. Subtract 1 from that to get the return. That's in fractional units. If we multiply that by 100, these would be percentages. So this number here indicates 2.03% increase in the price of the S&P 500 index fund. We take the adjusted close because this it might not actually be the close. The close and the adjusted close differ slightly because the adjusted close accounts for splits, and in this case actually the one that matters, S&P 500 index fund, doesn't split, but it does have dividends that are paid out to the investors, this adjusted close accounts for the fact that dividends are paid out in kind of the month-to-month changes in the price. And so when we compute this percentage return of the adjusted close, this gives you, from the investor's perspective, what the holding period return was for that month. We lose 1 month for lack of data, and so we have 59 months of data where we can read this in. Now, you'll notice the date. We look at date. That's stored as a factor. That's not going to plot very nicely. So what we need to do is we need to adjust, we need to convert the date field into the right format. And so you can see here, it's month slash day slash 4-digit year. If we looked up the format of on how to do this sort of online, that's going to be %M to get the 2-digit month. The slash needs to be there because the slash is in the format, like the way that the dates are given to us. %D, the slash needs to be there, and then %capital Y. If we do this and we can plot this, you can see kind of over time what happens to the adjusted close. You can see the data run from sort of 2000, late 2013 to, well, what's the latest date we have here, to sort of late in 2018. So this is a file I downloaded about a year ago for the purposes of this illustration. Okay, so just get some characteristics. Keep in mind the NA, we're going to have to deal with that, so we need to say that we need to remove the NAs in our calculations. So the mean return is 0.91%. Standard deviation of returns is 2.9%. So there's actually quite a bit of volatility in this S&P 500 index fund. That's pretty natural in an investments context. As 0.9% is 0.9% per month. So you can think of that as sort of loosely, you could multiply that by sort of by 12 to get you an idea of what the annual returns have been sort of over this period. Although the thing that you really want to do is you want to compound the returns to get an idea of what the total return is. Well, here what we're going to do is we're going to compound the returns. What was the sort of the total holding period return, holding period gross return? Well, that was 1.668. How do we interpret that? We have 66.8% more wealth if we invested all of our money at the beginning of this data period and held it to the end of this data period. How do we kind of average this per period for the gross return? Well, we can take that to 1/59th power. That kind of has this effect of sort of saying, well, how much per month would you be compounding at a constant rate to sort of get this return? You can see that sort of rate at which we're compounding, the gross return is going to be 1.008. That's 0.87% per month. To get an idea of what the sort of the geometric average is, that's kind of more comparable to that arithmetic average that we calculated. The geometric average is going to be 0.87%. Because of compounding, that's going to kind of catch up to this per period return that you're seeing on average for the arithmetic mean of 0.91. So you can see here, if we wanted to sort of think about this as like sort of using sort of how does that arithmetic mean relate to that geometric mean, we can compute the arithmetic mean. We can also then compute the standard deviation of the returns. So what we'll notice is that the standard deviation is 2.94%. The arithmetic mean is 9.1%. As we sort of had in the in the notes, there's this kind of relationship between the approximate sort of geometric mean of returns and the approximate the arithmetic mean and standard deviation. What you do is you plug in the arithmetic mean, that sample mean, subtract 1/2 times the standard deviation squared, and remember that this calculation assumes that we have a normal distribution. Notice is that if you compute this approximate geometric mean, that's actually quite close to what the geometric mean was when we calculated that just above. And so, so maybe that assumption of normal distribution wasn't such a bad one. Well, was it such a bad one? We could actually plot the histogram. It looks pretty symmetric, single peaked. There maybe is a little bit of a tail there. Obviously, in a data set of 60 observations, it's hard to be exactly normal, but I wouldn't think that this looks severely not normal. There aren't any huge outliers to sort of lead us to think that the distribution wasn't normal in the first place, right? So that's I think kind of one of the sort of useful things to kind of keep in mind is that then, like, you know, that assumption of normal distribution doesn't look so bad, so this approximate geometric mean equation isn't such a bad one. And as you saw in your projects, this kind of makes a conceptual point as well, which is that if you want to think about how effectively does this investment turn into long-term wealth, what you really want to know is how does the geometric mean look? Well, it turns out that, like, the geometric mean is directly harmed by a return process that has a high standard deviation. You can see that here, that for kind of the same arithmetic mean, the geometric mean is going to be lower for processes that have more standard deviation, because that volatility ends up eating into sort of effective compounding. We sort of discussed that at sort of another point in class. Now to kind of link back to sort of that reward to risk ratio, here's computing this thing called the sort of 1 month Sharpe ratio. You can see here the Sharpe ratio 1 month. That's just taking the average returns divided by the standard deviation returns, and for monthly, that gives you an idea that, like, for an additional unit of risk, how much additional expected return can the investor expect from this S&P 500 investment? Well, in the data, it was 0.31. Now, we may be interested in, like, well, what if I held this for that whole period? So let's just kind of imagine that we sort of do this for sort of a longer holding period. And I want to find out, well, what's kind of my 5-year mean? You just kind of applying rules of linear combinations. What's the standard deviation over 5 years? What is the how do I get the standard deviation? Just kind of applying rules of linear combinations. And now let's just say, well, what's my 5-year Sharpe ratio? Well, my 5-year Sharpe ratio is just going to be the 5-year mean divided by the 5-year standard deviation. And that would just be kind of what you would do, is you take, well, what's the expected return over this period, what's the standard deviation over this period. Give my 5-year Sharpe ratio, that gives me something like 2.38. Now, what if instead I did it this way, where I just kind of took the equations and divided 59 times the arithmetic mean, divided by the square root of 59 times the standard deviation. Turns out that arithmetic mean divided by the standard deviation, that gives me the 1 month Sharpe ratio, that's just up here. And then 59 divided by the square root of 59, well, that gives me this as well. Turns out that gives me sort of an alternative way to do this, and that is that if you wanted to know, well, what is the 5-year Sharpe ratio And you already know what the 1-month Sharpe ratio it is. It turns out that rules of linear combinations just imply that what you do is you take the number of holding periods where you held this, or number of months, and just take the square root of that and multiply your 1-month Sharpe ratio by that sort of square root of the number of time periods. That's sort of a useful thing that comes from linear combinations, but it's sort of helpful to kind of see that. Now I want to show you something that's perhaps even more interesting. You studied t-tests in quant. You should know what a t-test is. If you just do a t-test of the return, what do you notice about the test statistic? Test statistic actually is the Sharpe ratio spread out over that whole data set. Now, how come that's happening? Go through this a little bit in the notes. You should kind of review this a little bit, but like what happens is that the Sharpe ratio is just the Sharpe ratio from monthly divided by the square root of the number of sample periods. But what that ultimately is just the arithmetic mean divided by the standard deviation, and that whole thing is times the square root of t, which is the sample size in this context. Well, you can divide both numerator and denominator by the square root of t, and the denominator then ends up looking like the standard error of the mean. The standard error ratio of the sample average to the standard error of the mean equals the t-stat from our very familiar test statistic when we're sort of doing hypothesis tests. So there's this really integral relationship between the Sharpe ratio over kind of a sample period of historical returns and kind of this t-test of whether the arithmetic average equals 0. And so this notion of like a Sharpe ratio actually relates in kind of an interesting way to assigning statistical significance. We're not going to go too deep into that, aside from to just kind of point out there's that connection, but hopefully you find that to be kind of an interesting connection to make. So to kind of review, what did we cover in this video? Well, we discussed some measures of risk. In particular, we focused most of our fire on the sample standard deviation. Even though this related sort of measure, the value at risk, is maybe what we think about as capturing risk. We showed under a normal distribution that the value at risk is actually well approximated, or well one-for-one for what the sample standard deviation is. That is, when sample standard deviation goes up, under a normal distribution, the value at risk goes down. Both of those things reflect sort of more risk from an investor's standpoint. We then sort of used this to discuss sort of how you would form reward to risk trade-offs. I showed a little bit of the graphical aspect of that. Talked about a Sharpe ratio, and then showed some examples in practice in the context of the SPY ETF, which is sort of the classic S&P 500 exchange traded fund. Hopefully this kind of showed you a little bit about R, but then also a little bit about how these sort of measures of risk in an investments context matter. Thanks.